Hey guys, what's up? This is Andrew for TRENDLINES.com. So very quickly, for those who are watching my videos for the first time, let me quickly introduce myself. I'm a professional trader and I created my YouTube channel a few months ago to show you guys everything that I know about trading. So I mostly talk about technical analysis, but it's not only about reading the charts. It's also about reading the flows, which is, for example, the option open interest or the short interest that you can find on any stock. So let's do an update of these numbers on AMC and see what these numbers are telling us. Let's get into it. So the first thing, this is my chart. So once again, I won't go through all these drawings here, but you can see that my scenario is quite bullish. So of course, this is just, a guess, and I can be wrong, but this is what would make the most sense to me. So basically, I think that AMC would go to 35 in this first cycle. Then we'll see what happens. It will depend on the COVID crisis, on the vaccines, if people still want to go to cinema, all this stuff. But for now, we are developing in this 5 waves move. And for me, the target of this first cycle is 35. All right. Now, the reason I'm bullish, so I gave you the reasons, the technical reasons already. You have some bullish divergences. You have, all the indicators except for the volume that are pointing towards the same direction, which is bullish. And one of the reasons as well that I talk about sometimes, but maybe not enough. And it's very interesting, I think, to keep an eye on it. So of course I do, but I think you guys may want to understand exactly what this data means. It's about the option market. So let's have a look at it. So to analyze the option market, you can find all the information on Yahoo Finance, for example, and you basically check the number of call options that are on every strike and every maturity. All right. So here are the strikes. I go up to 40 because this is where I find a lot of open interest. And I take all the maturities. So 30th of April is, put to 0 already. This has expired, but I take 7th of May until, September. So I have all the maturities here. So this took me a lot of time. I went on Yahoo Finance and I got all this data for you guys. But, checking the open interest. So for example, you can see that randomly, I take the 10 strike on the 14th of May, no, on the 7th of May. You have 15,000 open interest. So you need to multiply this by 100 to get the total number of shares sitting at this strike. Then we need to make some assumptions. We're going to suppose that retail investors are actually those who are buying those call options, which is, I think, a very good assumption. You're going to see why I did this assumption very soon. And this is not enough, to only compute this, the total open interest. You're going to find that if you sum, for all these maturities for every strike and you sum up the total open interest, you're going to come up with a number that is the maximum number of shares that retail investors are going to be long if actually these options finish in the money. But what is interesting to do at the beginning is actually to see the exposure. So the maximum would be 15% if all these options actually finish in the money. But when we are trading at 10, you have an associated delta for each option. So let me explain what is the delta. The delta is the exposure of each option. For example, if you take an at the money option, you're going to have around 50% delta, which means that you have 50% chance to finish above the strike level at the maturity, and you have 50% chance to finish below your strike level at maturity. The delta has a formula that depends also on the volatility, which actually creates some higher than 50% exposure for at the money options when the volatility is very big. But I won't go too much into detail here. And using this formula, you can compute the delta of each option. Once you do this, you can sum all this exposure for each maturity and each strike and actually come up with the total short exposure that is on the option market. And this data is very interesting to actually use because it is a short position that is not seen in the regular short interest that is published on FINRA, for example. And for now, when AMC is trading at 10, this number is 5%. And what I like to do is to check where it is coming from, because on a regular option market, for example, like Apple, and it is very interesting to actually see where it's coming from. So for example, you can see that on the 40 strike, the total number of shares is the biggest. All right, this is the yellow curve that is here, but the exposure is not the biggest because once again, this is an out of the money option. So you can see that the yellow curve is the highest here. The highest point is at the 40 level, but the red curve, which is the exposure, is actually the highest at the 10 level strike. But imagine that we go, for example, to 20, and you're going to understand what is a gamma squeeze. See how it changes. So this one has not changed much, but this one has increased. The yellow curve has not moved at all. And now let's imagine we go to 50, for example. Now you can see that basically the red curve is converging towards the yellow curve here, and that the maximum exposure is going to come from this 40 strike. And the synthetic short is going to grow from 5% to 15%. It's going to converge towards this number because all the delta is going to converge to 1. And this is actually what can create a gamma squeeze, because once again, remember what we said at the beginning of the video, we assume that these option positions are held by retail investors, which means that professionals like market makers or hedge funds are actually short this same call options. So if the investors are getting more exposure because the delta is increasing, because the probability of finishing in the money is higher, then the market makers are going to see their short position increasing as well. And they're going to be forced to buy some shares in the market. This is the process of a gamma squeeze. And this can only happen when you have this out of the money strike levels that have a huge position in open interest. And this is the case for AMC, as I just showed you. Another information that is very interesting to look at, and I'm going to do this for you guys because I'm an option trader, is to monitor the volatility of this very high strikes. So for example, right now for AMC, the volatility of the 40 strike for the June maturity, I'm going to stick to the June maturity for now because it's more stable than taking the 1 week maturity. And for now, it is 226%. So this is very big. This means that market makers need to have protection against this scenario. And to get protection, what they do is they increase the volatility that they use to price this option. And another thing that is very interesting to notice is that you can check the delta once again by using the formula I showed you. So let's go back to the initial scenario where AMC is at 10, like here. And you can see that the delta is basically the probability to finish in the money, like I said. For example, for the 40 strike and June maturity, by using this very huge volatility of 226%, the delta is 50%, guys. So it means the market makers give 50% chance for AMC to trade above the 40 level strike in June. It is huge. And let me just give you an example. Imagine the volatility is 30%, like a random stock. Okay, then the delta is 0. So you see, the higher they put this volatility, the higher the delta is. For 50%, still 0. If I try 150%, now it's 24%, you see? So if the volatility goes too low, this is the reason why. It is an indicator of what professionals think. For example, with a volatility of 130%, they think that there is a 17% probability that AMC is trading above 40 in June. But right now, guys, like I showed you, the volatility is 226%, which gives it a probability of 50% of finishing above the 40 level. So this is a very interesting information for you to have, and you can only have it by understanding how the option market works. And this is why I wanted to show you that, guys. Now, we're going to do something even more interesting. We're going to check the short interest on AMC since I started my YouTube channel, so since November. And what we can see, guys, so I take all the information here. You can see that the equity float moved from 80 million shares to 400. All right, so we know that there was a lot of shares emission, but the short interest grew as well, especially in the last months, guys. There were 50 million shares short in the market, so hedge funds are actually, selling it. We know that. And now it's 90 million. So the short interest increased just in the past months from 12% to 23%. So this information shows you that they cannot help but selling it. Hedge funds just think that AMC is overvalued, and we can see that the fight between retail investors and hedge funds is starting again, because they're increasing their positions. For example, for GameStop, I'm going to show you guys very soon, but this number is stable. So the battle is happening on AMC right now. And this is why AMC got actually hammered in the past week. It's quite easy to understand. It's just hedge funds putting pressure. But we know that someday it is game over for hedge funds. And basically, the way those guys work is that they follow some data and they have some triggers that are gonna tell them that they need to buy back their shorts. And one of the data they're gonna follow, and it's not only the traders, it's the managers of those guys. So, they basically have no choice. When this data is showing them the signal to buy back, they're gonna do it. And the data I'm talking about is the DTC, which is day to cover. This is the meaning. And it's basically how many days it's gonna take to cover the shorts if they trade roughly the average volume. So you can take the average volume on 1 month or on 1 week. And if you take the average volume on 1 month and you assume that they need to cover the 23, so the 94 million short shares, this is going to take them roughly 3 days. And if you use the 1 week data, like here, this is going to take them 3.2 days. All right. And we can see that this is starting to get hot. We are getting closer to some dangerous levels. So once again, if you look at the past, for example, here we didn't even have this, all right? So you don't need to have it, but when you have it, there is just more chance that hedge funds buy back their shorts. And basically for GameStop, we were going between 5 and 10, all right? So this is the critical area. So we are not there yet, but once again, if we grow, here I was assuming, I was assuming AMC at 40, but for now, AMC is not at 40. Let me go back here. Okay. Sorry for that. So right now, the synthetic short is at 5%. So the DTC is between 2 and 2.5. What you just saw, guys, it was when AMC is at the 50 level. Then it was to show you guys what is the gamma squeeze, because this is going to go to 14%. And then the DTC is going to increase to 3. So you can see that for now, the option market is not huge enough to create a DTC at 5. But once again, we didn't have it in January, and still AMC kind of short squeeze. But it was a very light short squeeze for me, because you can see that there were 45 million short shares and we only went to 38. So they only bought back 7 million shares, but this was enough to create, some panic on the upside. So whatever, let me go back here. Now it's at 10. All right. So here 5%. Here I update my data. Okay, 5%. And so we are between 2 and 2.5. So I think it's interesting to just keep an eye on this so that we are ready whenever there is some signals that the short squeeze is approaching. Now, one more thing I want to show you guys is some option strategy. So for now, you have this kind of P&L profile. You are basically long shares. So if AMC, let's say you have 100 shares, so you can lose $1,000 and you can make $5,000 if AMC goes to 60, for example. So this is your P&L profile. So basically your loss if AMC goes to 5, which is, something reasonable, it's kind of the worst case scenario, is $500. And if AMC goes to 40, you can make $3,000. Now, remember what I showed you guys on the option market. I showed you that the high strikes have a very huge volatility. It's 226 when it's only 130 for the at the money strikes. This means that the options are more expensive because market makers need protection against this 10 million shares equivalent short position that is here. So what is smart to do, guys, is actually instead of, for example, of having 100 shares, let's say you sell your shares. I know you guys don't like it, but I'm just showing you what kind of strategies you can make using options that are very smart and that professionals are actually doing. So now your P&L profile is 0. Remember, at the 5 level, you could lose $500. Now, let's imagine that you are making another strategy and that you are buying some call options. So let's say you buy, for example, for 600 US dollars. So let's put 600, all right? 500 US dollars. So you buy 10 options at the 20 strike on the June maturity. So I checked the price. Okay, so the price is here. So it's worth roughly 32 cents. And the 20 strike costs 55. All right, we keep this in mind. And let's say we buy 10 options. So if we lose everything, this is now the P&L profile. So a call option, I remember you guys, you make money only if you finish above the strike level at maturity. So this is the payoff, max of 0, spot minus K. And if AMC goes to 40, now you can make 20,000 US dollar. So basically you have the same downside risk. So maximum downside risk. I remember, let me remind you guys how it was. But you can make 20,000 if we go to 40. You were like this, all right? If you have 100 shares, you can lose even more, but you're going to lose 500 if we go around 5. But you can make only 3,000, all right? So this is just one example. Now, this is when actually I can give you some cool stuff to do, guys. Instead of just buying a call, you actually need to sell what everybody wants to buy, all right? Because this is what is expensive. So the high level strikes are actually the most expensive one. So we're going to sell, for example, the 35 strike. Why 35? Because it's the maximum level of my analysis. So I would do this. If you don't want to sell the 35, you find another one. But look, so the price is 30 cents. Here I buy for 50. So now the strategy only costs me 240 US dollars. And I still make the same money at the 35 level, but I decided to cap my upside performance and to reduce my entry price. And if you guys are comfortable with actually, you don't want to sacrifice the upside performance, or you are fine with spending more money, you just double it, all right? So now you guys spend the same amount of money as for the 20 strike call option, but you can make twice as much profits if we go to 35 as you used to for just the 20 strike call. So it's just about rebalancing your risk. And this is what is important when you want to trade options. If you want to be on the right side, you need to sell the high volatility strikes and you need to buy the low volatility strikes. This is what we do. So that's it for me. I hope you guys enjoyed this video. I hope I managed to explain to you how to read the option market information. So the volatility, that is very important. That is showing you roughly the probability of a share to trade above a given level at a given time. It's the probability that professionals are giving to it. So it's very interesting to check this value. And you can also use the short interest that you used to have in the past to see when the squeeze might happen. You can use the DTC. And you can combine all this information with your technical analysis to actually build up some very profitable strategies that you know won't cost you too much. You can define your maximum loss. This is what is interesting about options. So I hope you enjoyed this video. And if you guys did, please don't forget to click on the sub, like, and bell button so you're going to be the first to know when I upload anything new. And stay close to shore. I'll see you guys.